The moderator for the next panel is Dalia Agashore. Dalia is an investment director with CDC, and she's responsible for investing and managing a $350 million portfolio of unlisted closed-end funds across Africa, with a focus on both ESG standards and supporting the UN's SDG. And she's got a long track record in the industry across Africa. Dalia.
Thank you. Can everyone hear me? I think, yes, great. Thanks, everyone. We've had a slight change in some of our panel members, but it's going to be a really interesting discussion, so glad you could make it. I will let the panelists introduce themselves briefly before we delve into the topic. So first up, Martin.
Yeah, my name is Martin Ewald. I work for Allianz Global Investors, which is one of the asset managers of Allianz Group, responsible for the private side impact investments on the equity part, and I will talk about Africa Grow, one of the funds we manage within my team.
Thank you. Greg.
Hi, my name is Greg Murray. I'm the founder and CEO of a company called Cocoa Networks, which is a climate technology startup with about 1,000 staff in Kenya and India.
Joe.
I'm Joseph Rome. I run a funds management business focused on Africa, equities and fixed income. And we've been on a really interesting journey actually through ESG, impact, sustainability, with very specific challenges given the nature of information around Africa. So we run an impact strategy as well. Yeah.
Very interesting, and as some of you will know, obviously CDC has been on a journey when it comes to impact investing and investing with a sustainable lens. So it's been really interesting getting prepared for this panel last week and hearing the panelists' views. So let me start with the first question. How do you each think about sustainable investing? And by that I mean, what are some of the key questions you ask as you look at opportunities? Martin.
I would always break down like whether it's social impact or environmental impact for us. We do represent LPs from like regulated capital, as in like life insurance investors, third-party money, and also then public investments. And then of course it's always the question like what to prioritize. So in the case of Africa Grow, for example, we do have a social impact target. So we want to create jobs in the small medium enterprises in Africa, something we can do because we are a blended structure. If you just run non-blended vehicles, of course, then impact first is, especially on the social side, is more difficult to achieve. So therefore, I would say, like for example, in Europe, it's more environmental topics, as in how much CO2 can you save, water, energy efficiency, topics like that.
And when you say blended structure, I'm not sure people in the audience will know what you mean by that. Can you explain that?
Thanks, yeah. So a blended structure is essentially a vehicle. In our case, it's a German LP. And you blend public and private money. So by doing that, what you manage to achieve is that private investors can invest into some areas where they otherwise might not be able to. In our case, this is regulated capital coming from life insurances, as said, going into private equity and venture capital funds in Africa, which is usually for someone who is solvency oriented is quite difficult to achieve. And those blended structures essentially say like you take the public and the private money you invest, and then you define like the payout, the waterfall on the exits, which means you can give like the private investors higher degree of comfort. Beauty is that this allows the public hand to multiply their efforts, and at the same time so mobilize that capital required to flow into emerging markets.
And you said you've raised 200 million already through a blended structure. Do you see this as a growing investment offering for AGI?
Yes. So stay tuned. There's more to come in that space. And it makes sense because it allows the institutional investors to broaden their scope. It allows us to also create more impact, and it's really a system which works. Traditionally, it has been more on the debt side, but now we also see more and more equity funds running after that scheme, and we will continue to launch further vehicles.
Very interesting. So if I can sum it up, it's Looking at it from ESG lens, you're looking at investment solutions from an E perspective, the environmental perspective, but you also have opportunities that look at specifically the social element of it. Is that the right?
Top notch.
Good. I'm just going to skip over Greg because he's got a very interesting perspective as an entrepreneur, and I'll talk to Joe first about your definition of sustainable investing.
So, and as I said to you earlier, Dahlia, we've been through a journey. So for us, sustainable investing is not ESG. That's a risk screening tool. So we would never invest in a company with very poor governance, for example. More recently, what we've started to do is, and this going back a few years now, we've looked at potential investments and investments we make through the UN Sustainable Development Goal lens. It's challenging because there isn't a framework and there isn't a consistent framework. So we've had to do a lot of that work ourselves. But so we then look at the alignment of all the investments we make to the UN SDGs, and we quantify that, and obviously we invest in the companies that are more aligned. But I think, I can talk a lot about that in terms of how we think about sustainability and impact investment. But I think Martin used a very good word. He said prioritize. And I think this area is so broad that one of the areas that we've really then focused in on is the E and the environmental side. And in Africa, that's been very challenging because, unlike investing in a developed market or an emerging market, there is no data in terms of carbon intensity for the companies that we invest in. So we've had to go out there ourselves, get Scope 1, Scope 2, Scope 3 emissions, clean all that data up, and that's been our area of focus. So that's our priority. That might not be other people's priority, but that's how we've evolved our thinking around sustainability, because we think that's a particularly big issue on the African continent. But at the same time, we'll show you the metrics for resources, resource usage and waste for all the investments we make. But I think climate is the one that we really focus on. Yeah.
That's very interesting.
Yeah.
Greg, you're in a very interesting position in that you get to select which investors you'd like to bring into your company. So how do you go about selecting, in a way, which either family office or institutional investor best meets your request, but also your ethos?
Select is a strong word. Historically, we have about 65 shareholders, and we've raised a round of capital pretty much every year for 7 years. And we're a 7-year-old company, but we only have had revenue for about 2 years. So the first 5 years of our life, we were writing code, but also writing legislation, inventing hardware, but also building factories. 500 staff pre-revenue. So, the word select again is hard. I kissed all the frogs you could imagine in order to assemble the cast of characters that are in our cap table. And historically, that meant you can't really go after the DFIs when you're sort of pre-revenue, right? And there isn't really. I think there was $30 million worth of venture capital in the continent of Africa when I set up the company, and now it's maybe $3 billion or something this year. So it's been great growth. But you take the folks that don't do hardware, which is 95% of the venture capital industry globally won't touch hardware because it's sort of icky. You've got to build factories and these sorts of things. So where we sort of selected, where we ended up getting some traction was in family offices. Mm-hmm. So capital owners that really saw what we wanted to do, had a really long-term horizon, and wanted to swing for the fences. And now it's a bit easier. Now it is a matter of selecting because we punch through and it's all working. But you can imagine the risk on offer when I was selling prototypes and PowerPoints, right? It was really, really quite tricky. And I found that the right investors for us are the ones that genuinely want to swing for the fences. You find in this sort of impact space, there's a real gap between folks that are there to tell stories and folks that actually want to do the applied problem solving at some scale. But the applied problem solving obviously has a huge amount of risk. And so if you don't take a venture mindset to it, you're probably just playing at the margins for storytelling purposes. Not that different to the aid industry, I'd say.
Mm-hmm. And one other thing that you mentioned to me is that you prefer people with local context, or shareholders who have got the local context.
It's the nature of our business, I suppose, is that, you know, I'd often have to spend 3 hours explaining this is how retail works, this is how the local energy markets work with regards to this particular form of cooking energy, this is how the mobile money system works. So I'd spend a few hours before I even get to start talking about what the company does. Whereas our African family offices, I don't have to do that. I can dive straight into they're context rich, I suppose. Whereas the super smart foreign investors are context dumb, and you have to take them on a journey to actually understand the context generally in order to bring them up to speed. I found that that's not the case with the 20 or so African family office investors that we have in our cap table.
So the journey when you went out fundraising 7 years ago,
Mm-hmm.
sounds like it was harder than it is today. But so today you get your pick, I imagine.
Today there's there's a broader range. It's institutional now. There is venture capital, private equity, family office, commodities trading groups. There's a whole range of folks that are getting into climate investing now. Something in the water in the last 18 months that has the whole net zero fever that's taken off, and so it's more straightforward now. But it's still a bit of a grind.
Mm-hmm.
The actual process, particularly with the world opening, but not quite open in terms of people's comfort around getting on planes.
So it's seeing through the labeling whether someone is actually genuinely doing it to invest with a sustainability focused mind, or just the labeling of we're an impact investor and we like what you do, and it fits within our.
Yeah, are they paid to take risk? The actual individuals involved. That's my framing, my lens. And if they're not actually paid to take risk, then they probably shouldn't be doing venture capital.
Yes.
But yet, in the impact space, there's a huge opportunity for venture capital to create impact multiples in the same way you create financial multiples.
And venture capital in Africa, I'd say, because obviously the macroeconomic cycles are very different than in developed markets, which brings me to the next topic. Martin, what are your views on both the short-term and long-term performance of the sustainable investing asset class?
That's also like a big one, but may I just also tune in on what Greg just said, like with regards to VCs funds and like the general funding. This is also something we do see. Like we're also investing into venture capital in Africa. Had a closing, we'll have another closing, and what we try to do is like to also get the whole asset class to be more liquid, both also allowing more exits, just more capital flowing into, and then therefore like we are fund of funds with Africa Grow, but also trying to play that catalytic role, which I guess like ultimately should trigger down then in like more liquidity and then also giving you more options to really select whom you want to be working together with. Long-term outlook on the asset class, what we do see really is, as you also were just referring to, is like the interest also in like proper impact investments, as in like what's the real data coming out of that, and what does it really mean? Because I think we all saw an era of people really aiming to do something good, but never really knew how to do it, like how much they were doing. And this is also what I particularly like about like the whole venturing approach, that you can really measure and you can gather bottom-up data, which you then aggregate, and then in turn like us reporting to our investors also are able to really showcase that. And I guess like this also goes in line with more transparency about like the underlying, also more willingness of investors to get involved with the transaction, really trying to understand better, because there's more data, not just the financials, but also then the real data from below. And I think especially for sustainable targets, there's such a great need, such a hunger for investment. So I really think it will grow, but as said, like it's hard to access for other investors than, like you said, family offices are your investors, because they can take some risks other institutional investors can't. So it's just also mobilizing that capital. Otherwise, very hard.
And do you have to fight for allocation to Africa versus other sustainable opportunities that AGI is developing in other parts of the world? Give us sort of a flavor of what it's like.
So in our case, like as we're an asset manager, like we always build vehicles which are then just like targeting like a specific asset class. So Africa Grow was just built in order to invest into private equity venture capital in Africa. But of course we compete for capital. So we really need to do the whole package to your investors. So return levels, risks, and then nowadays also then the impact you can generate. In order to mobilize the capital. So therefore, it is a competition for capital internally as well as externally, which is getting more intense, of course. But at the same hand, like as impact targets are getting more important by the day, I think we're in pretty good shape with all the sustainable investments we run.
And how do your investors view the risk-return impact trade-off? So for Africa Grow, when they put money into it, are they happy to take a bit more risk on the return but expecting a better payoff because it's Africa? Or the impact is so attractive that actually on the return they're okay to come in below expectations?
They can't sacrifice returns. So this is really one of the points, which is why we need to build such blended structures, because they cannot say, like you generate such a great impact, like in your case, this is really like impact on the ground, but they have a responsibility for their balance sheet. So they can't say, it should work, which is why such blended structures really help to lower the risk they face.
Right. Joe?
Maybe I can just add to points that Greg and Martin have made. I think there's a lot of financial innovation in the space, which is going to add a lot of credibility to impact investing and also unlock a lot of flow into certainly African impact investing. And there are a number of examples, but I think particularly in the bond and credit space. I'd use a specific example like sustainably linked bonds. And I was looking at a bond for a shipping company where the coupon, the maturity and the redemption is linked to very specific KPIs. So that, to Greg's point, that helps people take risk because there's a clear pathway to an outcome. And I think that will give investors a lot of comfort to put allocation to work in the African impact space. So I think that area, is going to be a big growth area, and that's going to certainly create a lot of opportunities for businesses looking for capital that can adopt these type of financial instruments. And then maybe just to Martin's point on returns. I think there's a perception that impact investing means lower returns. We've actually written a white paper on that to show that's actually not the case globally. Companies that are aligned to, for example, the UN Sustainable Development Goals, their financial performance, not necessarily their market performance, but their financial performance tends to be very good. And that makes sense. Typically, those are the better quality companies with strategies that are thinking about broader impact issues. So I thought those are 2 points that are worth just adding and reiterating to what you were saying. Yeah.
And you talk about allocating more capital into some of these new types of structures. Greg, you mentioned another interesting idea when we were speaking about this. There's a carbon 2.0 idea where you think more money needs to flow into that, and it would be tremendous for Africa if it did. Can you speak to that?
Sure, yeah. There was this sort of carbon 1.0 cross-border flow in that 2006-07 through to 2012 period, mainly into Europe. And Africa pretty much missed out on that. It was a lot of sort of China, India, Brazil type inflows, and then that market basically died. It's now back with a vengeance. It's many multiples of the scale of what went on 10 plus years ago, and I think it's a huge opportunity. we're directly involved. We're pretty active as an exporter of carbon based on the emissions we reduce into the South Korean emissions trading scheme, for example. We sell under long-term offtake agreements to coal-fired power generators that are forced to buy credits at really high prices because of their cap and trade scheme there. But we're all watching with bated breath what happens in Glasgow in a few weeks from now. But I expect it to be a positive outcome, and I actually think that there's going to be the opportunity for inflows onto the continent that exceed the current scale of the African venture capital inflows. Big statement, because it's currently about $3 billion a year on the VC, but I think that's the scale of the opportunity that exists, and most of the folks that are capitalizing on that are not necessarily on the continent today. There's a lot of folks gearing up in the trading firms, the banking firms, a lot of activity in Australia, in the existing sort of regulated markets, but this knitting together of markets, and particularly the opportunity for Africa to become a major exporter of carbon, that's something that's early, but going to be massive 2 years from now, 3 years from now.
So an organization like CDC would be wise to look at buying up more forestry land because we could subsidize potential future investments as a result of that?
Yeah, I mean, maybe. I think definitely there's natural, nature-based solutions. There's an opportunity, but you look more broadly. Look at conservation, right? You look at some of the large ecotourism type plays that are trying to conserve, large conservancies. There's a massive opportunity around soil carbon, around land-based carbon for those groups, in the same way that Australian cattle farms, at very large cattle farms, are participating and winning out of the Australian methodologies and the Australian carbon markets there. You could bring some of those same approaches into the land sector in Africa and do have a huge win for conservation. That would be one example. We're in the business of replacing commodities that destroy the forest. So specifically replacing charcoal with a liquid ethanol cooking fuel through a network of about 1,000 shops in Nairobi that have our fuel ATMs. And so that activity of switching charcoal to ethanol is similar to taking out palm oil in Indonesia, right? It's directly about switching, and so that's something that we're able to monetize at really, really high prices. But yeah, the list of things that the different methodologies, the different activities and ventures that could be built is really broad. And a lot of it can just be technology transfer, stuff that's being innovated and built in other parts of the world, but actually has applications for Africa as well.
Really interesting.
Maybe I can just add to that. Sorry, Martin.
You first.
Because I think that the role of the CDCs in these markets is not buying the farm. That's actually the easy part. And we've looked at, for example, carbon sequestration in Australia. The reason why that's been such a success is because of policy and regulation that supported that. And that's actually what Africa needs. It needs CDC to sit with the African governments and make sure that the right policies and regulation are in place to support carbon sequestration as an example. So I would argue that's really the role of the CDC going forward. That's what will really make a difference and unlock these markets. Yeah.
And as we're on the wish list to CDC,
yes.
as we're running up to Christmas, I really echo both what you've said. I think, especially forest conservation, reducing emissions from deforestation and avoided degradation, REDD, something I did my first investment 10 years ago in Kenya. And it's exactly what you said, the carbon market died, everyone was really nervous. Now it's rebounding. It should have never gone that far from my point of view. But this is something really where you can see how to marry the dimensions, really environmental impact, social impact, and then the carbon credits being able to monetize. And I think carbon markets are a brilliant tool, because also as an investor, you can trade your credits in euro or dollar, whatever, and this denomination really helps you in financing. And therefore also I can really only encourage CDC to try their very best, like also to help that grow, because marginal cost of abatement, of course, in such projects is much lower than anywhere else. So.
Well, there's a huge piece of policy development obviously attached to that, which is not typically something we do as investors, but something we recognize, and we do see the gap. There are a dearth of actual opportunities to trade carbon in Africa. And it surprised us because we did a very short study over the last year, and it surprised us. But it is, hopefully in the years to come, something that we'd look to develop. By way of capital, I'm not sure about negotiating with different governments about regulation. Maybe on to the last topic before we open up for questions. How do we mobilize more capital into Africa? And I'd like to start with Greg first, because you've been on a journey to try and do that as an entrepreneur.
Yeah, I mean, how do we mobilize more? I can tell you how I'm going to do it. Continue to build what we're building. I mean, the task to paint a picture of what we're up to, solving this dirty cooking fuel crisis in most African countries, there's really only historically been one lever that governments have had, which is LPG, and subsidizing LPG, similar to India, Brazil, Indonesia. LPG costs about 20 times, from a capex perspective, what it is that we've rolled out in Kenya now. There's a third-party study done a few years ago that looked at the actual supply-side capex. So we don't need government subsidy. You get 20 times less the investment in order to create the same bang for the buck in terms of the consumer uptake. That's taken a reasonable amount of capital for us to do that in Kenya, and over the next decade we expect to invest about $1 billion in this strategy and taking this into about 20 other countries. And so that sounds like a big number, but it's actually it's $20 billion worth of consumer demand being served if it was an LPG solution, and obviously all of the associated fossil emissions that would go with that LPG. And so our approach to do that is pretty simple. It's to build and then raise capital from institutions as we go. It becomes easier and easier as people start to understand this industry that we're building and how it actually functions. It becomes something that more and more folks seek to dive into. To your point around policy, one of the things that we are doing, we'll announce it in a couple of weeks, but we've agreed with an African government, similar to sort of a pre-investment, the sort of agreement that you'd see that a power plant developer would pursue prior to project finance. Those sorts of agreements around taxes and tariffs and standards and the policy framework that enable capital to flow, we see that as our role, probably not the CDC's role, but our role to go in and meet the investment promotion agencies or the cabinet or the Ministry of Energy or the finance people, whoever it is that are responsible for negotiating those sort of agreements and saying, look, we'd love to invest in your country, but at the moment there's all of these things that make that not possible. If we can create an agreement in a legitimate manner, that will enable us to actually to bring, and in the case of this African nation we're about to announce the agreement with, it's a reasonable amount of capital to build a countrywide network that actually solves this dirty cooking fuel problem properly. So I think the policy part of it is a big part of it, particularly when you're talking about innovation in a new industry that doesn't have the existing framework. There is no standards. We import hardware to those countries. You can't do that unless you actually write the national standard. There's tollgate taxes around VAT and tariffs that have to be removed in order to level the playing field with charcoal. There's a whole bunch of stuff that is required, and ultimately that I think from our perspective that makes a country investable versus the sort of the approach that we had to take in Kenya, which was just to turn up and hope for the best. We're not going to be doing that in terms of the investment into new countries. It's really got to be this sort of policy-led approach.
So again, policy development, but lots of education and spending time to
lobbying,
bring others with you.
Yeah, lobbying, sales. Yeah.
Martin, I suspect you'll say blended finance structures is one of them. Any other things to keep in mind? Yeah,
also what we do see is also educating the GPs. So that's the interesting part. Like for us, like for example, we co-invest with CDC, but when we come to the GPs and like when we negotiate our side letters, they look different. So as we're a commercial investor, we need to have like different provisions when it comes to, I don't know, tax change law provisions and stuff like that. And this in turn is confronting the local GPs with like how institutional investors in Europe would think. And once they are used to that, this also will allow them to mobilize more capital. And that's something we already see. For example, if we are in some of the funds, being bloody German, like conservative investor, that really helps the GP to showcase, like we're investable, and that then will have like knock-on effects or like mobilize further private capital. Other thing what we're doing is we're running a technical assistance facility also to support small medium enterprises and the whole ecosystem. And then on top, of course, like as you say, like the blended structure in order to just mobilize first-hand institutional capital.
Yeah, I'm sure many fund managers would like a GI in their roster because it brings a stamp of approval.
Yes.
Yes.
I think there's an opportunity to pick specific issues to get more capital. So just taking a step back, as investors on the ground, we have data to show the impact of our investments, and then the next step is to link that to outcomes. And I think it's a time when there's skepticism around impact investing, and there are issues such as greenwashing, which those are real issues. But if you link those investments to outcomes, and I mentioned sustainably linked bonds as a specific example, but I think a nice example is also something like transition finance. And Nigeria is a country which is the largest flarer of gas globally. Now it's a London-listed oil and gas company. Do you punish them for investing in compressors and reducing the gas that they're flaring? They're a dirty, grubby company in the oil industry, but actually they're doing a lot of good. And I think if one can communicate that to allocators and investors, and I think transition finance is a specific area where there should be more allocation to Africa. And I think, so one can't be all things to all people, but that's, a nice example of a specific area where we can all make a difference. Yeah.
Thank you. I am going to open up for questions, maybe take one or two questions because that's all we have time for. Yes, please.
Hi, yes. So earlier in the panel, there was a discussion around venture capital and a discussion around exits. And so I used to work in Southeast Asia, and I think one of the big challenges to getting more capital into the space, especially venture capital, for impact investing, was a lack of kind of credible exits in the space. So I'd be interested to hear what type of exits, the kind of the market in Africa. What does the M&A market look like, and how just general what your thoughts are on that.
Sure, and before we answer that, does anyone else have a question which we'll take last? Yes, please.
Just talking about carbon markets, and particularly Greg for you. As the jurisdiction around who owns the carbon is coming onto the agenda, how does that put your sorts of projects at risk if we have governments deciding they own the carbon?
Good, all right.
Yep.
Thank you. So let's start with the exit environment. Martin, do you want to speak to that?
It's all questions for Greg, I guess.
So over the last 7 years, venture capital's gone from nothing, and it's multiplied 100x, but it's only been 7 years. It's like one fund cycle. And so you're starting to now see exits occur. 5 years ago, perhaps you didn't, because there hadn't been really much time for that natural cycle to play out. So you are seeing M&A activity. There's some sectors that are leading in that, the fintech type sectors. You're seeing a lot of A, investment, and B, now acquisitions from larger technology companies, or indeed some listings as well. So I think it's going to take the same pathway as the Southeast Asian space, but it's really only now the end of that first sort of fund cycle, I suppose. I expect it to continue to grow over the next few years. It'll be at $3, maybe even $4 billion this year in terms of the aggregate amount of investment in. but we are starting to see in some of the sort of well-trodden sectors, some of that exit activity. Yeah. And on the carbon, it's a risk for sure. The idea that there might be, effective expropriation is the way to think about it. But I think that's tempered by the fact that governments stand to win substantially through the Article 6.2 mechanism. So there's Article 6.4, which is the private sector cross-border market, and then Article 6.2 is how governments are incentivized, developing country governments are incentivized in particular to meet their targets. And there is going to be some friction around the accounting and around the fact that when I export tonnage from Africa, that basically counts against the nation's sort of inventory. So there might be a tendency to try and sort of overreach and say, okay, well that's mine. But the point is, it is a rule book that governments will have to comply with. It's not something that they can just sort of make up their own rule book around if they seek to participate in the government-to-government flows. And I can tell you, they're all very excited around this great green genie that's going to solve their treasury problems. But in order to make that happen, they have to comply with this. That's why it's taken 5 years to develop the damn rule book. There's a lot of emotions and vested interests at work, but I think it does work itself out. If it was penalising governments, right, without the corresponding sort of investment or financing flow to them, then that would be problematic. But yeah, some of the wilder ideas that I've seen floating around, we're going to treat carbon like a national resource, and you're going like a mineral or petroleum that you're going to need to, all of that stuff just isn't going to really fly if the government seek to participate in the international flows that are possible for them directly under Article 6.2.
And maybe just to add to the exit perspective from an investor's perspective at CDC, I think the VC space in Africa is still very much untested. And the one thing that you see in Southeast Asia is obviously you have much bigger populations per country. And I think that makes a big difference when you're exiting a company, be it either to a strategic or even outside investors, because there's much more demand for a certain product. And so we've obviously seen some very interesting exits over the last 18 months or so on the continent. And for certain businesses that are doing some really interesting things, like Greg's, I think it won't be an issue, but there is a lot of capital flowing to the VC space in Africa, and I think it's going to be at least another 5 years before whether we see is going to be an actual success in terms of exit and liquidity opportunities. Good. Thank you, everyone, and thank you to our panelists. See you around.
Thank you.
Thank you, Dalia, and the panel. Brilliant.